Good afternoon, everybody. Welcome to the next installment in the Admirals Trading Spotlight webinar series. Great to have you all here joining us today for what should be an interesting session for us all. If you're joining us here today on Zoom, it's fabulous to have you here. You're all very, very welcome. If you're watching this later on the Admirals YouTube channel, then it's fabulous. Make sure that you subscribe, give us a thumbs up if you find this useful and helpful content for you. Today, we're going to be talking about an introduction, okay, to trading using supply and demand zones, something that lots of people, you'll probably hear people talking about it, and lots of people sort of, talking about how they utilize it. But if you're a new trader, maybe you don't really fully understand what it's all about. And so hopefully today's session will be the first of a couple of sessions where we will just talk about an introduction. And in the next session, we'll go on to even deeper into, well, actually, how do we utilize it for our own trading premises? As always, you're also, you're all very welcome. I appreciate that we have a broad range of experience here who join us. We've got people who are just starting out on their trading journey to experienced traders. You're all welcome. There will be something here for you all. And I also recognize that we have a global audience join us. So wherever you're joining us from the world, you're very welcome here, and Admirals welcome you here. Just remember that, ladies and gentlemen, also is that after the end of the session, you'll immediately get a survey to fill in, and I would really appreciate it if you could just utilize that, see what benefit and value and help you got from these sessions, and maybe if there's thoughts for future ideas, okay, on future topics you'd like to see, as that's your opportunity to put it in there. And ensure that we try and deliver the best content and material we can for you. So let's move on, shall we? Okay, I'll bring up the charts and the slides, and let's talk about an introduction to supply and demand. So just bear with us here a moment, ladies and gentlemen. Let's bring up these slides. There we go. Super. So I'm hoping you can see me. I'm hoping that you can hear the slide. Okay, it's great. It's lots of people here. Vincenzo, Tina, Phillips, Milan. You're all very, very welcome. Great to see you here. As I said, I appreciate we have a global audience, and it's fabulous here. And wherever you are in the world, I hope you're well and having a great week and enjoying these rather interesting markets that we're experienced this at the start of 2022. So. Just remember, here we are, Admirals, okay, a Forex and CFD broker that are licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and giving you the ability to engage with markets using both MT4 and MT5. If you've got any questions about Admirals, please get in touch with your account representative and they'll be very happy to help guide you. And if you want more timely content or time-sensitive content, be sure to subscribe to Admiral Telegram channel, as you can see there at Admirals. And what you'll find is that the content team, they are always putting out timely pieces of information on either bits of news or new sort of resources that Admirals are providing to you. So it's definitely worth connecting to them. What are we going to talk about today? Well, not unsurprisingly, this is about an introduction to supply and demand. So we'll talk about what is supply and demand, and we'll have a slide or two on the kind of, let's say, the academic element of it, but I'm not going to spend too much of that time on that, because as always, what we want to do is we want to focus on, how do you utilize this in your trading? All right, what can you take from here today that you could utilize in your trading next week, okay, tomorrow, whenever you're watching this. So we'll talk about where is it found on charts, how do we use them, and we'll have a little chat about, what setups work well, and I'll just be sharing a few ideas from my own experiences of how I use supply and demand. As I said, I appreciate we do always have a rather experienced bunch of traders here joining us. So maybe, it'd be interesting to know, maybe, of those of you joining us here today, which ones of you are already using supply and demand in your trading? And if you are, how do you find it? How do you utilize it? Okay, it's fabulous to hear what other people's experiences are. And it'd be great to hear that. And you can put that in the chat box up there as we speak. So thank you, Vincenzo. It's good you can all hear me and see me. That's always a good start, isn't it, for a session? But for those of you who don't know me, my name is Paul. I've traded for many years, okay, from trading from funds, okay, for clients, and also coaching and mentoring traders for many years as well. My own particular trading, okay, for my longer term trading and my swing trading, I tend to be a trend trader. And for my intraday trading, I tend to be a reversal and mean reversion trader. That's the way I look to operate. Philip says, I don't use supply and demand. I would like to learn. Well, you've gone to the right place and the right time, Phillips, for that. Okay, you're very welcome. And hopefully by the end of this session, you'll have had an introduction to supply and demand. And and if there is time, we'll sort of switch across to live charts and have a little look at sort of what's going on in the markets at the moment, all right, and whether we can identify particular areas there that might be of interest or use to us. Okay, super. Remy says, I traded after learning support resistance, and you find that lots of traders will go that sort of path. They will start with support resistance, and then as they grow, they might add supply and demand into their mix. And actually, when you see supply and demand and support resistance happening at kind of same areas and levels, that can be a very useful, very beneficial signpost of that is an area in the markets that we're going to be interested in. So, how to trade supply and demand zones, all right? As the slide says, lots of people have heard about trading using supply and demand, but may not actually be aware of what it really truly means. It is a simple concept that allows us to analyze markets and identify possible areas for higher probability trades. Now, I would consider it to be quite a simple tool. However, many people are either taught wrong or overcomplicate the use of supply and demand zones. And so today, in this first part, what we'll do is we'll explain them and share some simple ideas on actually how to utilize them. So Arturo says supply and demand makes a lot of sense. I also use the COT report against supply and demand zones. Any thoughts on that? Yeah, that's fascinating insight there, Arturo. Okay, supply and demand does make a lot of sense, and invariably when you are utilizing with the COT report, especially on kind of longer time frames, when there is an alignment there between supply and resistance zones, and where we might see changes or expect a reversal or a change in that particular market based upon a change in the COT report. It's that thing of, you've heard me talk about plenty of times, is about a confluence of events, right? It's ideally what I'm looking to do is I'm looking to do my business in areas, spaces, zones where there are two, three, four things all coming together in one time and place. That gives me, an edge, a higher probability that the market is likely to move in one direction over another. And it is about, as I said, two or three things coming together at a simple time and place that allows you to think of it almost like, you're setting an ambush, right? You're setting an ambush that, you're expecting, price to sort of, come in and trigger. And then that gives you your a place and time and place from where to actually to put your trade on. And that trade should be, an idea place to basically take the trade, but also, you can very quickly work out, where your stop loss would be if the idea doesn't work out, and where would be a possible target zone, depending upon how you look to manage a particular trade. So thank you for that, Otto. That's excellent. So, this is quite a busy slide. I appreciate, ladies and gentlemen, because it's the kind of academic bit, and supply and demand is kind of page one of most economics textbooks, and as you can read there, goods are bought and sold at what their perceived value is at the time, and that same applies for financial instruments, with the exception or the expectation that their price will change in the future and will be bought or sold at different prices, potentially bringing a profit for traders. Prices adjust according to willing buyers and sellers, and these in turn create supply and demand zones. The sellers represent the amount that is available for sale, all right, which is the supply, while buyers represent the amount is available to be bought, that is representing demand. It is when there is an imbalance between buyers and sellers that we see a change in price. For example, when there are more willing sellers, price will begin to fall until it finds more buyers, and then when there are more willing buyers, prices will rise until it finds more sellers. Knowing where these areas are on a price chart will give you an edge and allow you to follow the interests of bigger smart money, the guys who are really moving the particular markets. As we'll go on to in a slide or two, as traders, all right, especially in private retail traders, we're not looking to move markets. Okay, we wish it was that way, but it's not. But what it is useful to us, and this is perhaps where supply and demand comes into it, is it's in those areas that are almost like we're big major institutional traders, you know, it's all like they're leaving footprints there. Okay, they're leaving footprints of areas where there has been business done and where there is likely to be business done again when price returns to that. And knowing that, that is an edge for us, and that gives us, as I said a little bit earlier, it's like almost like a zone, an area where we could look to sort of set our own little ambush, all right, to basically to trade price when it comes back to that particular area. So, you know, as I said, that's the kind of academic bit. You know, I appreciate, because there'll be people here who are completely new to trading, you know, and also supply and demand. But the reality is, you know, what does all that academic bit mean for traders? That's what we want to do. As I said, that's what I want to focus on, you know, what you can learn today that you can take away and utilize in your own trading. So as the slide says, supply and demand trading is a trading method where the idea is to find points in the market where the price has made a strong advance or a strong decline, and mark these areas as supply and demand zones using rectangles or, you know, zones. We'll have a little look on the live charts, right? And the point in which the price has made a strong advance is marked by the trader as a demand zone, and a point where the market has made a sharp decline is marked as a supply zone. The main premise of supply and demand trading is when the market makes a sharp move up or down, the large institutions, for example, banks, hedge funds, etc., are not able to get their entire trade placed into the market. Therefore, they leave pending orders to buy or sell at that zone with the expectation the market will return to the zone and the rest of their trading position will be filled. Now, you know, if you're completely new to trading, that may be a little bit confusing. Have no fear, and we'll explain that. We'll break it down a little bit more over the next couple of slides. You know, bear with us, okay? We'll just, let's say, kind of like we're sort of peeling the layers of the onion here, ladies and gentlemen. That's what we're looking at. So what we're doing is we're starting, but we will add, all right, we will add more understanding as we actually work our way through. So let's have a look at it, right? Identifying supply and demand zones. You know, at first, we look at a chart for an area where price has strongly shot up from, strongly accelerated away from. That is demand. Let's bring up the old drawing tool here, okay? Bring up the old drawing. You can see here, just on this chart, you know, there was actually a very strong move up here, wasn't it? You're right. And that had to start from somewhere. And it started from down here, okay? And that's what we would see. An idea is basically that is we would identify that as a zone of demand, because when price came down into it, and for whatever reason, right, what we could see is that, you know, as price shot away, there was clearly demand there. Okay, there was clearly, for whatever reason, clearly lots of big institutional buy orders there. All right, you know, and we know we're talking, you know, huge buy orders there. You know, as a you know, when you're starting out as a kind of private retail trader, you might, you know, sort of not really fully understand, because you have, like, you know, small position, very small micro position as you're learning. But of course, remember the big institutions, the hedge funds, banks, you know, they may have, you know, 1,000, 2,000 contract positions. That is a very big chunky position, maybe even bigger, etc. You know, for some particular instruments, right? And you know, when we're in there, okay, as I said, they can't always get that position on, you know, just at that one particular time and place. I will explain why in a couple of slides. But first thing first, okay, as I said, just as you know, as a new trader, when you pull up a chart, right, and pull up a chart, just have a little look there, okay? You know, where were the areas on the chart where you could see prices accelerated away from, okay? You know, it's made, actually, as you can see there, really big, strong moves there. And, you know, go back, and what you'll find is, you know, the kind of the little area there beforehand, that is a demand zone, right? That is where, you know, we know demand, you know, is, right? And what we're interested in is, you know, what happens when price comes back to this area, because price will do at some point, okay? And that's, you know, that's the kind of start of the premise of trying to understand supply and demand on our particular charts. On the flip side, okay, if we're looking for supply, right, first we're looking at charts for an area where price dropped away from, okay, because it's a supply. Prices rallied up here, and for whatever reason, okay, for whatever reason, it might, you know, it might be a big round, no, it could be a level of resistance, it could just be, you know, that an institution has to put an order on for one of their clients. But when you can just look at a chart and see where price has really fallen away strongly from, okay, not ground its way down, but actually just moved, you know, very, very quickly away from, well, then this, you know, we're looking at there, the area just before it we would identify that as supply. There is a supply, okay, into the market, which it overwhelms the demand, and you can see the price absolutely collapses. And so actually what we're interested in is that, that area there, we're interested in, well, what happens when, price eventually comes back to that area of supply. And that, as I said, the internet is a little bit tetchy this afternoon, so I'm hopefully that you can still all hear me and see me there. Let's check that you can do. Okay, excellent. Back in the room. All right, excellent. Thank you. There we go. Relying on the vagaries of internet on a Friday afternoon. But where were we? We were talking about supply and demand zones, and what does it actually mean? What does it actually actually happen? Okay, so what we're particularly looking at is that we are having what might be heard or might be described as a liquidity grab. All right, sometimes this is what we find ourselves being described as. What is that for a new trader? Right, well, liquidity, okay, is the ability to buy or sell something without causing a large price change. Whenever you see the market move, it is due to a lack of liquidity in the market, not necessarily because there are more buyers than sellers, but because there's a lack of liquidity. Now, liquidity isn't necessarily super important for, let's say, ourselves as private retail traders. It's not really necessarily an issue. But if you're a big institutional trader, if you're at a bank or a hedge fund, okay, or another financial institution, and you're trying to put on 1,000 contracts, 2,000 contracts, etc., this is where liquidity does become important. All right, this is where traders at those levels, they are constantly looking to identify areas where there would be liquidity, because invariably they want to get their price in without it actually moving as much as possible. Okay, because they're likely to move against them, and of course they know that it has an impact on all their particular profits, their kind of risk tolerances and management, etc. So they are very, very keenly aware, looking for pools and areas where there is liquidity. And when we see things move, right, things move really, really rapidly. If there's strong moves up, strong moves down, very often this is what will be determined. And traders will hear, they'll talk about it as is a liquidity grab. But we will describe that a little bit more over the next chart or two. So when someone places a market order, okay, they want their order activated at in that present moment, okay, at that particular price. What happens is when you do that, all right, it removes liquidity from the market. All right, just take a moment to think that. All right, when you're watching on your trading chart, you're on your trading platform, and you go to hit the buy, okay, and you want to order at market, okay, you want basically to do that. When you're doing that, it is actually removing liquidity. All right, because the person who is placing the market order is essentially demanding that his trade is placed right now. And as it says that his market order is then matched with someone who has a pending order to sell placed in that market. So, there's someone has placed a pending order, and it's when, you hit the bid, or, you're basically hitting a market order right there, demanding to be filled right now. Well, you're actually grabbing liquidity. You're taking liquidity that was sat there. If the market order is bigger in size than the opposing pending order, well, what will happen is part of the market order will be filled, but the rest will remain unfilled. So the market must move higher or lower in order to seek out additional pending orders to fill what remains of that market order. What this essentially means is pending orders add liquidity to the market because they are orders in which market orders will be matched with. So just as a quick aside here, let's get the old drawing tool here. I'm for the sake of the premise, this is, I don't know, we're going to say this is euro dollar at 120. Okay, just excuse my drawing there. But and I am, I'm the big institutional trader at XYZ Bank, and one of my clients is let's say is Ford Motor Company. Okay, it's Ford Motor Company, and they basically need to bring in, they need to sort of shift money around because they've got factories all over Europe, they've got factories in the US, and basically they have currency exposure. They need to effectively move currency around to basically to pay their bills so that they can build their cars and their vans, etc. And the chap on the treasury desk at Ford calls me up, okay, as the trader at XYZ Bank, and says that I need to basically to have so many euros. I need to buy so many euros, okay, against the dollar to effectively pay my European suppliers. And so doing that, works out that I have to put on I don't know, let's say a 2,000 contract order, okay, within the Euro USD market. And so I'm looking to effectively buy euros and sell dollars, but at 2,000 contracts, what will happen is, as I said, there might actually only be, the pending orders there might only be, I don't know, let's say there might only be 500, all right, the equivalent of 500 orders at that particular level. So me trying to hit 2,000, orders, hitting the market with 2,000 orders, is a little bit extreme, but for the sake of this, little hypothetical exercise, what we can see is, me trying to hit, buy sort of 2,000 orders. Well, invariably, it instantly sort of soaks up the 500 orders that have been sat there and pending. And then what actually happens is the price will rise, okay, to basically to find places where more of that big order block can be filled, and that is what we see. That's what they see, and and it's just effectively on the other side as well. Namely, if I have to put in orders to effectively to sell, there's just oversupply there, and what will happen is the price will fall until it finds areas where more of that order can actually be filled. So there you go. So hopefully that just gives you a little bit. I'm trying to keep it as simple and as basic, because this is just about an introduction here in part one. All right, it's just so that you can understand what is actually going on in the background. When we see these moves happen on a chart, I want to be able for you to start thinking, well, what has actually happened there? Okay, what's going on? How does that play out? What do I have to do as a let's say just as a normal private retail trader to be able to work with that? Okay, and make the most of it. So, as I said there, as retail traders, we do not trade at a size big enough to affect the actual market price. Placing and exiting trades is something we never really have to think about, okay? Yes, there will be times and moments perhaps around, extreme, events, or, particularly news events where, there might be challenges. But for large institutions, however, getting in and out of trades can be a big problem, especially if they're trying to fill, orders for their clients who have given them, a particular, a price or a range that they wish to operate at. And invariably, they don't want price to sort of drift away in a liquidity grab, because that will have an impact on their own profit bases, okay, from their own particular trade. So understanding that that area of liquidity and looking for areas where institutions can do their business, that becomes a key for them, all right? And as I said, because they're operating at such size, it leaves footprints, right? It leaves footprints, and that's what we see on our charts. Because the trades they place are so big, one of the primary goals of let's say an institutional trader is to get a trade placed into the market with as little impact on the market price as possible. This means finding places in the market where a lot of liquidity exists. And this is where it does become relevant to us, because a lot of the time, pockets of liquidity tend to be found at places where retail traders put their stop losses. All right. And I just want you to I'm going to repeat that just so you can take it on board and think about it. A lot of the time, pockets of liquidity tend to be found at places where retail traders may have their stop losses. So hopefully that just take that on board. Just think about that, okay? Starting to maybe for completely new traders, give you a little bit more understanding about, why you see markets move, accelerating in areas like that, moving really, really fast because there's a liquidity grab going on. Why is that happening? It's because institutional traders have been trying to get their orders on, okay? And the market is moving fast to basically find other areas of liquidity where basically lots of that big order can be filled, all right? And so once you're able to recognize that and understand that and see that on your charts, well, then that gives you a little bit of insight. Okay, that gives you a little bit of knowledge. All right, that's insight, knowledge that is actionable, that actually you can utilize for your own particular trading decisions. So what happens is, and this is terminology that you will see supply and demand traders talk about, is that as price moves, it creates what we would probably call swing highs and lows. Price never moves in a straight line. Okay, you'll have known that. You'll see that, right? The extremes of these moves can be marked as bases, and just like the ones marked opposite, you'll see here. What we'll find is, and you will hear supply and demand traders talk about this, is when those bases are created after a rally, okay, or after a drop, they form either what's known as a rally-based drop or a drop-based rally. All right, then just think about what is actually going on there. As Philip says, these appear to be similar to support resistance levels. You're absolutely right. You will find very often, if you're doing the same things, you will find with particular levels, support and resistance levels will, as I said, they will align with supply and demand zones. Not always, but a lot of the time they will. And if you just think about, what has actually happened, why have we created a support and resistance level in a space? Because price has probably moved up to it and then it's moved away. And that's what draws our eyes. That's what we see the move away. And what's actually happened as that, well, price has rallied, it's based, and then it's dropped, or it's come down to a level of support from which it's rallied. It has dropped, based, rallied. Okay, so there is it's the kind of two sides of the coin. All right, and my view would be two sides of the coin, namely that they are giving you areas or identifying areas where large institutional traders have been doing business, and that becomes useful to us. All right, that becomes information. As I said, think of it like you're stalking an elephant, all right, on the African plains, all right. When that elephant leaves its footprints, that's what you're looking to trail. Okay, that's what you're looking to watch and follow. And this is a version of that on price charts that we see. So, looking, as I said, identifying things like, rally-based drops, RBD or DBR drop-based rallies, that starts to become kind of useful to us as traders. So, but importantly, how are we going to use this information? What is it about it that basically helps us? Well, remember, this is just part one, so to speak. This is just an introduction. There'll be a part two where we go into the real intricate details. But what we're going to do for part one is we will just look at simple setups at areas of supply and demand. What you will find, we'll have a little look at the charts in a little bit, is very often some traders, once they have identified those supply and demand zones, some traders will just simply buy or sell at those supply and demand zones. So as price, drops back into what we know as demand zone, they will literally, once they've identified, will just quite literally have either a market or pending orders, just literally buy those zones. Or if price rallied up back into a supply zone, they will just literally have an order to basically sell at that particular zone. And that that can be very useful for some traders. Personally, what I prefer to do is that once I've identified those particular zones, well then I wait to see rejection candles print at those time and zones. All right, that's what I like to do. I like to let the market play its hand. Okay, I let the market show me what it wants to do. There's no perfection there. Okay, there is never any perfection in trading, because what you're doing is you are shifting up and down the risk reward spectrum by waiting for the market to give me a confirmation of that particular area or zone, or what it's going to move away from that zone. Well, then that means that my trade might take, I might be a little bit later getting the trade on because I've had to wait for that confirmation. So maybe my risk to reward isn't as exciting or as large as someone who has just particularly just bought or sold that zone with a pending order. And that's fine. I'm happy with that. I like to let the market play its hand, all right, and show me what it wants to do. That is my comfort zone of how to trade areas like that. Okay, I'm very happy. I'm very comfortable. Other people who might be more aggressive might just, as I say, just simply have a pending order to buy or sell that zone, or they may just literally hit the bid, or lift the offer when they're just basically hitting those particular areas. And that is, as I said, that is partly about where you particularly sit on the risk spectrum yourself as a trader. But for me, as I said, identify those zones, and then look for, wait for rejection candles to print in those particular zones. Okay, and very simple price action ones here that you could use are, engulfing candles, pin bars. All right, this is let's say, kind of another level. It's another way to utilize very simple price action, right? But you're waiting to see it actually happen at particular supply and demand zones. So, if you, an outside bar, an engulfing candle for very new traders, as the name implies, all right, an engulfing candle or an outside bar is formed when the high and the low of that bar, that candle, fully engulf the range of the preceding candle or bar. And what it does, for me, my definition is it must include the complete engulfment of the entire range of the previous bar, not just the body, which is what some people will actually, work on. For me, it actually has to, completely. It has to completely engulf, all right, not just the body. It has to completely engulf, all right, and that's my kind of standards, shall we say, when we work with that. Engulfing candles don't happen as often as we would like, but they are a good signal when they do occur, and it provides a trader with a clue to the next possible move. So when I will see engulfing candles at those bases, okay, after we've had a rally, okay, and a base and we're getting ready for a drop, or we've had a drop and we're identifying a base and ready for the next rally, when they do happen in those particular areas, that's when we start to become, just a bit more interested. That's when we start to sort of, like what we see. So, very simple examples, right, okay, of engulfing candles here. Remember what I said, I think that it has to engulf the complete range of the preceding bar, all right? Some people just will actually just basically trade it off if it's the body. And my view is that an engulfing candle has to completely engulf the high and the low of the preceding bar. Those are my standards. Others may differ, but that's the way I like to operate. Okay, that's the ditch I'll die on in terms of bringing that in terms of how to operate there. Another one is a pin bar, okay, a rejection candle, and it's a very popular trading trigger. So you'll hear it sometimes called, a pin bar, or a high test or a low test bar, rejection candle, a hammer, a shooting star. I don't actually really care how you label it. All right, wherever label works for you is fine. The important thing is you actually understand the psychology of what has happened to create that particular candle. And a good pin bar, it should have the open and close of it is within the previous bar, the candle wick. All right. So, I apologize for that. It's just clearly my internet is having a bit of a doesn't want to put a shift in, and so it's trying to leave the room. So I apologize for that. But what I was just saying is that lots of people start off trying to trade pin bars. Okay, as a very starter way to identify markets. What we're talking here is that's all well and good, but it's even better when we have these candlesticks, engulfing candles, pin bars, happening and occurring at particular areas, okay, of supply and demand. Remember what I said right at the start is that we're looking for a confluence of events, right? Where 2, 3, 4 things come together in one time and place. That is what gives us, a little bit of an edge, a little bit of an ideal understanding of what is likely to happen next, and that is what we're look to do. Rudolph, yes, I am back again. All right, it's as I said, I apologise that the internet has been just a little bit shaky this afternoon. I do apologise for that. It will hopefully we'll be fine for the remainder of our session here. Okay, but I do apologise. And what will happen is this has all still been recorded. And that'll be cleaned up by the fabulous team there at Admirals, and you'll be able to watch the video on the YouTube channel and be able to sort of watch that again if you've if it's been a little stuttering. So I said apologise for that, but here we are, way to go. So very simple examples of pin bars, and what I would say is that there are if you want to have more in-depth insight into engulfing candles and pin bars, if you go into the Admirals YouTube channel, what you will find is that there is actually a host of great content. There's some super videos there from myself and from Marcus and Jens, but there's also particular ones looking at, focusing on pin bars and engulfing candles. So you can really go and watch those and get a deeper insight. Today, what we're just talking about as an introduction is just looking at, what happens when we see things like engulfing candles and pin bars occur at particular, areas of supply and demand. So here's your task from today's session. I'm all for setting little bits of homework that you can take away and start to look at. Just go away, all right, and look through your favorite trading instruments. You might already know that, okay, you might already be doing it, okay, but just, go and look at your favorite trading instruments and see what you can do. If you can try and identify possible supply and demand zones, okay, just identify areas where market has either accelerated, upwards from, okay, because it's leaving a demand zone, or basically, where markets have actually, collapsed, places there, where what we've done is created a supply zone, and you might be able to then build into that understanding where we see, identifying where markets have done a drop, a base, a rally, or they've done a rally, base, drop. So that's your homework. Look at how prices reacted when it has returned to those zones, okay? Look at how prices reacted, okay? When price came back to it, and we'll have a little look at it here on the live charts for a few minutes, is did it move away from those areas, okay? And if it did, what happened? Was price actually printing, an engulfing candle or a rejection candle of some sort? Because as I said, you're getting a confluence of events there, okay? That supply demand zone might also be, an existing level of support or resistance. It might, as I said, just, moved away from there strongly, and now it's come back to it. Well, now it prints, and when it prints rejection candles there, that is the basis, of a trade idea, okay, which is what we will look at more, in session 2 of this particular kind of theme that we all take on board. So before we switch across to the live charts, just remember, supply and demand are areas of interest to traders. They are zones where prices has previously made very strong advances or declines, and what we are interested as traders is how price responds when it actually returns to those zones, okay, when we actually see price rally back up towards it or drop towards it. And that is the basis of a very simple trading plan, which we will discuss in more detail in session 2. And this is just the introduction into just supply and demand zones, and we'll move and shift towards basically actually actively trading supply and demand zones. So, let's have a look at the live markets, because it always helps. We can do it together. We can just have a little look and identify where the particular areas that prices has moved away from. So, but before we do that, don't forget to join us next time here on the Trading Spotlight webinar. So join us same time on Wednesday. Join me. I'll be back here where I'm actually going to be talking about scalping and intraday trading of European indices, including, what's the difference between scalping and intraday trading? What are the options, all right, for trading European indices? What are the best times and places to trade them? What are the best setups? And that will be Wednesday, 9th of February, 2 o'clock London time. Check your inbox for the webinar link, or you can head over to the Admirals website and basically sign up there. So, that'll be a good session, and you'd be very welcome to join us there. And if you have interest, or you want to contact Admirals, you can do so here. You can see the email address there is global@admiralmarkets.com if you've got questions about this particular session, or if you want to find out where the recording will be, or if you've got ideas for what you'd like to see us sort of touch upon in the future, you'd be very welcome to contact us. So, as I said, just bear with me a moment. We've got a couple of minutes. So what we'll do is we'll switch across to the live charts, just to have a couple of minutes of a quick look at going through and identifying some of those themes that we've just discussed. So as I said, just bear with us a moment, and we will do that. So just here we go. He says, all right, let's just bring up some charts and see what's going on here. Okay, so interesting. Let's have a look. I'm just going to bring up a chart here on this is pound against US dollar here. Okay, so it's just a little chart there. and this is the weekly chart. So I've just brought up here, okay, for us just to begin to start with. So let's zoom in a little bit. All right, there you go. Just the weekly chart. This is what I've just brought up here. So what I'm interested in is it always helps with the drawing tool. Here's just looking at here is I'm looking at areas or spaces where price kind of really accelerated up away from, or effectively, just dropped very strongly away from. So, in one particular area here, what I'm interested to see here. Okay, see how basically price had it rallied. See how it based there, and then it dropped significantly there, didn't it? Absolutely. This is a weekly chart, so that is that's a very big move, ladies and gentlemen. So, immediately, I'm starting to be interested in, well, clearly, it dropped very strongly from that. So when price comes back to that area, well, that might actually be of an interesting spot for me to view that. Now, of course, we're looking here at a weekly chart, so this could actually could take a year or two before it comes back to that particular level. But it doesn't really matter whether this is the weekly chart or the 1 minute chart. Okay, where you can identify where prices have fallen away or rallied from, that starts to become very interesting to us. And that is what we'd be looking to do here. Is just let's just clear this and draw in. What I'll be looking to do here for me is just use just draw a rectangle on here. Just here we go. And what I'd be interested is, so I would have that in there. Okay. Now here we go. I'm just going to draw that all out into the future. But for me, what I do, this is a personal thing for me. I'm not suggesting you have to do this, but what I do, especially if I'm like longer term, let's say this is a supply zone, there is what I do is I'll normally color that pink, so that pink just to offset it there, so that because actually it could take a year or two before it comes back here. What I'm interested is when I see price getting up towards this zone, it reminds me that okay, this is supply zone, so I'm actually I'll be looking for ideally sells here. And let's just draw the tool here. So price actually comes up here in let's say in 6 months time, and then maybe if the price starts to put in something like a bearish pin bar, okay, or as part of the price action puts in a big engulfing candle there, okay, well then what I'd be expecting from is price to have basically rallied, based, dropped, and that's what we'll touch on more in the next particular session. Okay, just looking at that. What I'd also be interested in seeing here is, let's just move myself out of the way a little bit. Just looking here is what I'm interested in is price dropped here, and it dropped quite significantly there, didn't it, ladies and gentlemen? But what we did is we based, but you can see how the candles, we moved away from those 4 weeks effectively. We moved away very strongly from there, didn't we? There was there was no, it wasn't taking any prisoners, was it? In fact, we can see it moved away there very, very strongly. And so, not unsurprisingly, what I'm looking at that is, that's a base there. Okay, there is a base of, there is demand there at around about that kind of 131, 132 level. So, what I'll be doing here is just clear these. Is once again, I would just be going and drawing myself a rectangle forward. All right, just to basically, there you go, projecting that forward, just to remind me that there is a demand zone there. And because prices come away from that, what I'll be doing is, I look to just basically change the color of that to effectively, here we go, I'll change that just to a pale green to remind me, because it might be, well, actually in this case, it might be a week or two, that when price comes back to that zone, that, it's just reminding me that I'm actually going to have a bullish bias, okay, and I might be looking for, like a, bullish pin bar, okay, or, a bullish, engulfing candle there that might give me an indication that we are ready to sort of move away. As I said, some people will just literally look to buy that particular zone. They might just have an order there with a stop loss beneath it, and that's it's a perfectly plausible way of trading supply and demand zones. My personal style is that once I've identified these zones, is then actually to sort of just wait to see how price plays out there. Okay, and as I said, if it prints out an engulfing candle or a pin bar in the direction of where I think the trade will travel with, well then that invariably works very well for me, and that's my particular style. Okay, but as all traders, we all develop our own particular style. So I apologize that we've literally kind of overrun a little bit, but that is that's always the way. I'm always trying to sort of pass as much information as I possibly can to you. Apologies for the kind of internet disruption there. I'm sure you know what it's like yourself. The best will in the world. Nobody wants it. It's just vagaries of the internet and stuff. So we apologize for that. But aside, there's plenty of information there that you can take away with. As I said, what we'll do is I'll pencil in a session for probably maybe a month or so away, where we'll go into part 2, and we'll just look a little bit more. We'll go more in depth on the actual trading element of it. So by all means, just remember there will be a survey that will come to you after this. We really appreciate it if you put it down. Has this been helpful to you? Have you ideas for what maybe you'd like to see in the future? This is your opportunity to do that. So just take a moment to please fill that in. That will help me, and my assistant Nastia should be very pleased with that. So it just remains for me to say, thank you for joining us today. As always, I wish you the very best of success in your own trading endeavors. I look forward to those of you who will join me next Wednesday for scalping European indices. Have a great remainder of the trading week, and I will look forward to speaking to you soon. Trade well, everybody. Cheers.